With returns ranging up to 12% annually, P2P lending platforms have really grabbed the attention of the masses. Since these platforms offer fixed returns, the layman investor finds these P2P platforms to be better than bank deposits. But is that really the case? Well, we'll find out during the course of this video. So P2P lending or peer-to-peer lending is basically a financial mechanism wherein individuals who want to lend money are able to connect with individuals and businesses who want to borrow money. We can say that in a way, P2P lending bypasses the need of a bank to act as an intermediary between the depositor and the borrower. Now, P2P lending is mostly facilitated by websites and apps. But a big question arises here. How are individuals able to trust these apps and websites to be the custodian for their money? Is there any regulatory body that governs the functioning of these P2P platforms? Well, to answer that, the Central Bank of India takes the responsibility of acting as the regulatory body for these P2P platforms. The Reserve Bank of India issues various guidelines on how these P2P platforms need to operate, and it also strictly states that companies that are keen to provide P2P lending services need to obtain the NBFC P2P license from RBI. It is because of this that most P2P platforms are regarded as NBFC fintech companies. At the same time, these P2P lending platforms are also required to maintain 2 escrow accounts that are operated by a bank promoted trustee. One of these accounts is meant for receiving funds from the lenders, and the other account is meant for collection of funds from the borrowers. These practices help to reduce the systemic risk in P2P lending. For those of you who don't know what systemic risk is, it is basically the collapse of an entire financial system due to an event that occurs at an individual entity level. For example, if tomorrow State Bank of India becomes bankrupt and collapses, then the entire financial system of India is bound to crash. Let's now look at some of the features of P2P lending platforms. Unlike fixed deposits, the funds that are lent in P2P apps can be withdrawn at any point of time. This liquidity advantage gives people a sense of flexibility with their money. With respect to the lending limits, the minimum amount that can be lent on these P2P platforms ranges from 500 to 750, and the maximum amount that can be lent is capped by RBI at 50 lakh rupees across all P2P platforms. Also, if we look at the tenure limit, then the funds can be lent out for a maximum of 3 years. Coming to the risk mitigation strategy of P2P lending platforms, they try to reduce the risk of lenders by using the loan diversification approach. This means that lenders' funds are spread across many borrowers, typically in the range of 200 to 300 borrowers. These platforms are able to diversify these funds in this manner using the AI and ML matching algorithms. Now that you know about the function of P2P lending platforms, let me also tell you about how these P2P platforms make money. These platforms actually charge a servicing fee from the lenders and an origination fee from the borrowers. Servicing fee is charged for collection of payments from the borrowers and passing it on to the lenders' accounts. Origination fee, on the other hand, is charged upfront from the borrower to cover the cost of processing the loan application, underwriting, and preparation of documents. Furthermore, there is a difference of 3 to 6% in the interest rate that is paid to the lenders and the interest rate that is charged on loans that are disbursed to the borrowers. This difference helps these P2P platforms to continuously pay high fixed returns, and at the same time, it also helps them to cover the losses that occur in case of loan defaults. Talking of loan defaults, these P2P platforms try to control the non-performing assets or the NPAs of the business by doing a proper credit check of the borrowers. The underwriter disburses a loan only when he has properly assessed the loan repayment capacity of the borrower. By looking at all these positives, it really feels like P2P lending space is really a miraculous money minting machine. These apps project as if one is taking very minimal risk to reap these 12% returns. But sadly, the truth is far from that. P2P lending apps are actually a very high risk investment avenue, and one needs to be really careful when lending their hard-earned money through these platforms. Let me list out all the major risks that are associated with P2P lending apps in India. First and foremost, P2P lending apps do not guarantee the safety of your principal amount. The loans that are given out through these platforms are actually unsecured loans because no collateral is kept by these platforms. Also, unlike FDs, which have 5 lakhs of principal and interest covered under insurance, the funds that are invested in P2P platforms are not insured by any entity. Secondly, the chances of your money getting stuck is very high. Let me illustrate how. The first scenario is when the non-performing assets become very high. If for some reason a lot of borrowers are not able to repay their loans, then in that case, the P2P firm will not have enough money to pay the principal and the interest amount to the lenders. On the other hand, the second scenario is when a lot of investors withdraw their money at the same time. It can be the case that due to a negative viral news, a lot of investors decide to withdraw their money. But the thing is that the borrowers will obviously not pay off their loans earlier, and so they will stick to their loan tenures. This would lead to a liquidity crunch for the P2P platform, and the entire firm would come collapsing down. Last but not the least, P2P platforms have very high risk borrowers. The first priority of any person to borrow money is from a bank because banks usually provide the lowest interest rate on loans. Only if a person is not able to obtain loan from a bank, he would go to P2P lending platforms or NBFCs. So one needs to note that these P2P platforms are mostly lending money to very high risk customers who have probably been rejected from the banks because of their poor credit history. This definitely increases the chances of default on the loans and the lenders losing out on their money. So to conclude, I would say that P2P platforms are not at all 100% safe and most people are better off not investing in them. However, if one really wants to invest, then not more than 5% of an individual's total portfolio should be put in these P2P lending platforms. It should just be taken as a means to diversify one's portfolio while also having it in mind that a very high risk is being taken for the fixed high returns. Hope this video gave you clarity with respect to P2P lending platforms, and now you will be able to take a wiser decision with your money. Thank you so much for watching. Like the video, hit that subscribe button and stay tuned for my next video.